Welcome to Alpha Recap, your end-of-day market wrap from stockalpha.ai. Today was really a day of contrasts. Big AI headlines and renewable execution rubbing up against energy tightness and regulatory noise. As always, if you have questions, you can reach us at stockalpha.ai and ask us directly.
Great to be here. Markets closed mixed today, and that felt about right given how some sectors were sprinting while others stalled out on policy and supply issues.
So, what really stands out here is the split between momentum in technology and clean energy, and the supply and policy pressures in energy, finance, and cannabis.
Yeah, that tracks. The headlines were basically two stories: AI and renewables driving a positive narrative, and then a bunch of real-world frictions pushing the other way.
Let's start with the tech side, since that was loud today. OpenAI reported the next model finished pre-training, and we saw more corporate integrations. Shopify with ChatGPT, Salesforce tools tied to OpenAI, all of which analysts say points to continued enterprise AI adoption.
Right, and for listeners who don't live in the model world, pre-training is the base stage where a model learns patterns from huge amounts of text and data. It doesn't mean a finished product, but it's the essential foundation before fine-tuning and real customer features. So it matters.
I mean, when you step back and look at this, pre-training signals upstream demand. More cloud usage, more server orders, more specialized chips. Analysts note that those CapEx flows tend to ripple through hardware suppliers and data center services.
And we heard that play out in conversation today. Folks flagged server and semiconductor supply chains as places to watch for the knock-on effects of AI milestones.
Quick reaction. On the clean energy front, there were some concrete wins. Offshore wind hit a 2.6 gigawatt milestone. Robotics helped accelerate a 1 gigawatt solar build program. And U.S. storage installations set a new record at 18.9 gigawatts. Those are tangible execution signals.
Yeah, those numbers matter. When projects move from planning into actual capacity, it helps address intermittency concerns and gives utilities something real to model into earnings, not just promises anymore.
Right. And the other thing is that storage at scale changes the math for renewables. It reduces the curtailment problem and supports more reliable dispatch.
But the day wasn't all sunshine. Energy markets tightened on supply headlines. LNG disruptions, a halted Russian port shipment, and constraints on U.S. shale output pushed the narrative toward tighter gas and liquid fuel balances.
That tightening is the sort of thing that quickly works its way into industrial input costs and can pressure margins for manufacturers and transport operators.
Exactly. Traders typically reward short-term tightness with higher near-term prices and more volatility. So volatility in energy can cascade across sectors.
Quick reaction.
Big move.
We also had some notable corporate capital moves. SL Green completed a refinancing of about $1.65 billion, and Coca-Cola announced a $650 million strategic push into Fairlife. Those are different kinds of balance sheet plays.
Yeah, SL Green's deal shows sizable commercial borrowers can still access debt markets, albeit at different pricing than before the rate hikes. And Coca-Cola's spend signals product diversification. Not an acquisition, but a scale commitment to a brand.
So, what really stands out here is how capital dynamics matter across sectors. Refinancing in real estate, growth rounds in flexible office, and private credit scrutiny showing up in finance briefs.
On the policy and regulatory side, today had a lot going on. Fresh attention on crypto from regulators, PFAS legislation impacting manufacturers, a router ban affecting some foreign hardware, and mixed signals in cannabis policy.
Honestly, I was a bit surprised by how many small policy items added up. Regulators create event risk, and in sectors like crypto or cannabis, even small rule changes can materially change economics.
On cannabis, the headlines were mixed. A bipartisan banking bill that could help operations was offset by state sales declines in places like Illinois and pushback in Massachusetts. That paints a picture of uneven demand and continued uncertainty for cash flows.
And finance had its own headwinds. Regulatory caution, private credit scrutiny, and fraud concerns kept a higher risk premium on some banking names, even as AI-related demand boosted technology-adjacent financials.
The Nintendo pricing tweak and the router ban felt like a tech soap opera. Hardware pricing changes plus regulatory sourcing constraints can move unit volumes and margins.
Which circles back to a cross-sector theme. Small or operational items in device makers can ripple to software publishers and game developers because addressable market and ARPU were affected.
Let's pause with a short reaction.
Yeah.
Right.
Time for the big picture themes that tied today's briefs together.
First, AI as a cross-cutting accelerant. Analysts note that the pre-training milestone and corporate integrations are showing up as revenue and cost signals across tech, consumer, and finance. It's boosting cloud and server demand upstream.
Second, energy tightness was a clear cross-sector ripple. LNG and geopolitical disruptions raised marginal fuel costs, which then pressured industrial margins and made renewables and storage more attractive as strategic alternatives.
Third, capital and credit dynamics were central. Big refinancings and growth rounds show liquidity exists, but private credit scrutiny could tighten terms for weaker borrowers. A watch list item for real estate and mid-cap corporates.
Fourth, regulatory and policy noise was a unifying risk factor. From crypto expiries to PFAS rules to router bans, policy was the day's wildcard.
Fifth, content, distribution, and network investments were front and center in communications and media. Content drives demand for distribution, and network rollouts can lift average revenue per user.
So, what really stands out here is that no single headline is decisive. The market is looking for corroboration across suppliers, capital flows, and regulatory signals.
Let's turn to the day's most notable single items. OpenAI's pre-training milestone was probably the top tech headline. Not a product launch, but a key step toward improved model capability and wider enterprise adoption.
Energy tightening was the top market mover. The LNG issues and halted shipments from Russia reminded traders that supply shocks still matter a lot, especially with constrained shale output in the US.
Utilities had those milestones we mentioned, 2.6 gigawatts for offshore wind and 18.9 gigawatts of US storage, which are concrete indicators of execution on the energy transition.
And on corporate moves, SL Green's refinancing around $1.65 billion, and Coca-Cola's $650 million push into Fairlife were notable for liquidity and strategic redeployment.
Crypto had a big event risk item, a $14 billion Bitcoin options expiry, which often creates short-term volatility as positions roll or get unwound. At the same time, institutional tokenization and custody wins signaled infrastructure maturation.
Okay, 3 short reactions.
Interesting day.
Lots to watch.
Yep.
Now some actionable insights. I'll be clear, these are analytic signposts, not recommendations. First, monitor energy spreads and storage builds, because with supply shocks, forward curves and storage rates tell you about pass-through to industrial costs.
Second, position your watch list for AI supply chain exposure. Look at server orders, data center expansion announcements, and chip equipment commentary. Those are leading indicators of AI CapEx translating into revenue for suppliers.
Third, treat regulatory and policy developments as event risk triggers. Crypto expiries, banking bills for cannabis, and manufacturing rules like PFAS can create asymmetric return windows.
Fourth, track corporate credit access and refinancing cadence in real estate and growth markets. Refinancings like SL Green's show markets are open, but terms matter. Spreads and covenant changes are leading indicators.
Fifth, read cross-sector signals together rather than reacting to single data points. For example, multiple software vendors reporting AI revenue acceleration plus heavy server capex is a stronger signal than one product announcement.
Looking forward to the next 30 to 90 days, expect volatility around energy and crypto expiries, continued AI announcements driving upstream capex, and policy developments that could trigger sector rotation. Renewables execution will be a differentiator for utilities, and credit windows will shape real estate outcomes.
So, what really stands out for the month ahead is that the market will reward execution and punish missed timelines, especially with renewables and refinancing events on the calendar.
Final takeaways. Analysts note that AI momentum and renewables execution are powerful themes, but they were offset today by tangible supply risks and regulatory noise. That produced a patchwork market rather than a clear directional move.
For listeners, remember this was an after-market close recap. Everything we discussed happened during the trading day, and markets have already closed. Use these cross-sector signals as inputs, not as a sole trigger for any action.
If you want one line to take away, watch whether AI milestones convert into durable capex and recurring revenue, and watch whether renewables projects actually come online on schedule. Those two answers will help explain which sectors keep momentum.
Thanks for listening. If you have questions about anything we covered today, head to stockalpha.ai, where you can ask us directly, and we'll answer live. For more market analysis and insights, visit stockalpha.ai. Catch you tomorrow.